The stock exchange was once a cathedral of noise, open outcry, hand signals, paper slips flying like confetti. Today, the loudest thing on the floor is the hum of refrigerated server racks. Trades are decided and executed in microseconds by black boxes no one is allowed to open. A retail app flashes by, but before a thumb leaves the screen, cables and code have already interpreted, rerouted, and repriced the intention. If the market is a conversation, it's one spoken at a speed human ears were never designed to hear. Orders are no longer shouted. They are translated into electric impulses and sprint through mazes built for them. The crowd didn't vanish, it simply became software. The modern market isn't always a place so much as an architecture. Rules encoded in matching engines, incentives embedded in fee schedules, and geography measured in nanoseconds. The people imagined on the floor stand nearby, but the real action lives inside climate-controlled cages where temperature matters more than the tie. The comforting story says algorithms provide liquidity, increase efficiency, and democratize access. That is true on calm days and for small sizes. But black boxes don't only provide, they decide. And the design of those decisions, who stands closest to the wire, who sees what first, who gets paid to internalize flow, determines where profits flow and where risk quietly accumulates. To understand how markets ended up as machines that priced the world at light speed, start with the first speed wars. Long before microwaves and fiber, the edge was a wire stretched across a continent. In the 1860s, Western Union's telegraph carried quotes across the United States. Traders hired runners and pigeons to shave minutes off the route between Philadelphia and New York. When Edison's stock ticker arrived in 1867, it didn't just print numbers, it printed latency reduced to paper. Whoever read the tape first glimpsed the future for a few seconds. Arbitrage clerks sat with rulers along the tape hunting for tiny divergences between exchanges. Time was not abstract. Time was spread, captured by anyone who could get information to move faster than price. The lesson never changed. He who sees first can steal a moment from the future. 77, the tools evolved. The principle did not. By the 1980s, computer programs linked baskets of stocks to futures contracts. It was called program trading, and the logic was mechanical. If the futures moved, the stocks should follow, so buy here and sell there and pocket the difference. On a calm day, the scheme worked like a metronome. On October 19, 1987, feedback loops amplified routine hedging into a cascade. Sell programs triggered more sell programs. Prices didn't simply fall, they fell faster than human judgment could catch them. Afterward came hearings, reports, and circuit breakers. The promise was to watch the machines. The deeper message was quieter. When algorithms share a logic, they can share a blind spot, and when many try to squeeze through one exit, the exit becomes the trade. The 2000s replaced human specialists with matching engines, software that pairs buyers and sellers and prints a price. Regulation NMS, launched with the good intention of ensuring best price routing, accidentally built a racetrack. If a better quote existed across town, routers were required to chase it, and the microsecond penalty for slowpokes became a business model for the fastest. The market splintered into a federation of lit exchanges and a shadow network of private venues called dark pools. The old floor still exists, but most of the market migrated to fenced rooms surrounding the exchange's brain. Co-located servers sit inches from the matching engine, cables measured like Olympic lanes. Every foot of fiber a noticeable penalty. Structure shapes behavior. Build a maze, and someone will breed an animal designed to sprint through it. Speed stopped being an attribute and became a strategy. High-frequency trading firms paid to put their servers beside the matching engine. Routers grew clever, some cleverer than others. A retail broker promised best execution, but best depended on who defined the term and who paid for the flow. Market makers paid retail brokers for the privilege of filling small orders internally, a practice called payment for order flow. Retail orders, on average, are not informed. They are lumpy and predictable, and that predictability is valuable. The retail investor sees a slightly better fill than the public quote and feels favored. The market maker sees a stream of coin flips biased in a useful direction. Both can win until volatility arrives and the coin lands on its edge. Latency arbitrage looks exotic from the outside, but remains a stripped-down truth. Prices on one venue update fractionally before prices elsewhere. An ETF jiggles on exchange A, one constituent lags on exchange B. Slip a trade into that microgap and skim the difference. One bee, one flower, one sip, millions of times a day. Think of the market as an orchestra with each instrument mic'd to a separate channel. If one headset has less delay than another, one listener claps in time, the other claps just late enough to look foolish. In a market of machines competing to be right first, right converges toward first. The comforting myth says liquidity is a substance poured into markets by benevolent firms. The reality is more conditional. On May 6, 2010, U.S. equities plunged in minutes and snapped back almost as quickly. Liquidity vanished as if someone flipped a switch, because many did. When risk spiked beyond model tolerances, programs canceled orders to protect themselves. For ordinary investors staring at screens, the lesson was visceral. The book that looked deep turned shallow at speed. 2 years later, a dominant market-making firm shipped an update with a dormant flag flipped the wrong way. The algorithm proceeded to buy and sell phantom positions at machine pace, and a balance sheet disintegrated in under an hour. Losses weren't because of a brilliant rival or bad research. A switch, a sequence, a blind spot. Nothing more mystical than that. After each crisis came ritual penance. More safeguards, kill switches, circuit breakers. They helped, and they matter, but the pattern persisted. The same pipes that amplify liquidity on calm days amplify chaos in storms. When the music is soft, the speakers are pleasant. When feedback arrives, hands cover ears. Dark pools tell a subtler story. Private venues let institutions match large orders away from prying eyes to reduce market impact. That can be healthy. A pension fund shouldn't pay a tax merely for announcing its size, but darkness invites strategy. Tiny ping orders feel for hidden liquidity. Midpoint orders split the difference between bid and ask. Router games learn a pool's habits and anticipate fills elsewhere. If the public market is a well-lit stage, dark pools are the balcony, where the view of the play is clear, but the whispered deals happen in the aisles. None of this is inherently sinister. It simply means the price seen on the screen is not the only price. When half the conversation happens off mic, trusting the transcript requires faith. Then came the retail boom. Fractional shares lowered the ticket size. Zero commissions removed friction. Playful interface design turned trading into a casual tap. Commissions didn't vanish. They moved into the plumbing. Payment for order flow turned retail streams into a commodity, and wholesale market makers competed to buy them, promising better prices than exchanges could provide. For small orders on quiet days, the promise held. For volatile days, spreads widened, fills hesitated, and the private handshake met public chaos. Liquidity is a choice, not a duty. When uncertainty spikes, the firms that make the market often step back, and the physics of supply and demand reassert themselves with a vengeance. What lives inside a black box? Proprietary code, yes, but also a philosophy. The best performing strategies can be summarized with 3 verbs. Predict, not the next quarter or next year, but the next millisecond. Will that quote update? Will this order cancel? Will that midpoint fill? Prioritize among thousands of possible actions, which protects edge, hit now, fade and repost, hide size, route dark, collect a fee, avoid a fee, defend a position, protect. When the world changes faster than the model, stop, cancel and widen, hedge, disconnect. Flip the book if necessary. These machines are automated judgment under constraints. Constraints are values made explicit. Define the reward as capturing spread while avoiding inventory risk, and a market is created that looks deep until pushed. Define the objective as filling a client within a narrow cost band, and signals become predictable enough to be harvested by someone slightly faster. Incentives write code. Code writes markets. Defenders of algorithmic markets offer evidence. Spreads are tighter than a generation ago. Commissions lower, access wider. Matching engines handle torrents of orders with astonishing reliability. Redundancy across venues increases resilience. Machines don't take bribes. They only do what they are programmed to do. Much of that is true. Detractors respond with an equally grounded case. Liquidity is conditional. It's present until it isn't. Complexity obscures tolls. The more steps between intent and execution, the more rents hide inside the pipe. Externalities are real. When an algorithm misbehaves, the bill goes systemic. Flash crashes, busted prints, withdrawn quotes, shaken confidence. Both sides are right enough to make the debate eternal. The machine doesn't care about fairness. It cares about goals. Fairness must be engineered in, inspected, and enforced. Efficiency arrives on its own because profit hunts it. Across centuries, the pattern is familiar. Ancient mints diluted coins to solve a problem today and exported pain to tomorrow. Modern markets dilute transparency to solve execution today and export fragility to tomorrow. In the 1690s, sovereigns invented perpetual debt, a machine to finance the state as long as belief endured. In the 2000s, designers invented market microstructure, a machine to finance liquidity as long as confidence persisted. Both promise stability, both demand trust. In 2008, financial institutions privatized gains and socialized losses. In 2010 and 2012, algorithms privatized speed and socialized glitches. Different decades, same transfer. From the many who assume the system works to the few who build and rent it. And yet the machinery isn't a villain. Engines are immoral. They will optimize whatever objective is given. The responsibility sits with those who design objectives, write rulebooks, and supervise plumbing. The phrase, trust the market, has shifted meaning. It no longer asks for trust in visible human intermediaries. It asks for trust in the incentives embedded in machines never met. That's a heavier promise because code can make a mistake without embarrassment and repeat it perfectly until someone intervenes. The black box touches everyday investors in plain ways. A market order is a confession, a willingness to accept whatever is offered at whatever speed. In a machine world, confessions are monetized. A limit order is a rule, a boundary set, so that the machine must come to the chosen price. Order types, post-only, immediate, or cancel midpoint peg, seem arcane, but each changes who sees the order, when it becomes visible, and how likely it is to be harvested by strategies aimed at predictable behavior. Venues differ like neighborhoods. Some route orders to wholesalers for rebates. Some promise no payment for order flow and charge in another form. Free is not free. It is a menu with prices hidden in the descriptions. For professionals, a different checklist emerges. Diversity is protection. Homogeneous models, trained on the same data and rewarded by the same function, will converge on the same mistake under stress. Latency diversity matters too. Not every decision needs the fastest path. Sometimes deliberately being slower reduces exposure to herd behavior. Plumb for failure. Build kill switches that are human. Simple. One click, one action. Practice pulling them. Assume someone else's cloud outage will become one's own problem. Assume a dependency thought irrelevant will suddenly be the only one that matters. Where does the next break appear? Crises tend to emerge from the edges of systems. Model homogeneity creates synchronized behavior, the modern version of everyone trying to leave through the same door. Liquidity cascades occur when protective algorithms yoke risk controls to volatility measures, and all retreat together. Plumbing concentration creates single points of failure disguised as efficiency. A few firms making a lot of markets, a few venues hosting most flows, a few data centers hosting most code. History will not plagiarize its old scripts, but it will rhyme. Complexity hides risk until risk floods complexity. And yet, there is opportunity in this arrangement. The same machinery that can shave a penny off a trade also reduces lifetime costs of investing. Tighter spreads and lower explicit fees make compounding kinder. Hidden tolls remain, but they are smaller than a generation ago. The trick is literacy, not cynicism. Understand that price improvement on a quiet afternoon and fragile depth on a panicked morning are two faces of the same design. Accept that liquidity is not a lake but a tide. Prepare accordingly. The picture on the exchange floor is now an image from another era. The human's role has shifted from maker to monitor, from pilot to passenger, comfortable with autopilot but mindful of storms. The market became so fast that governors had to invent brakes to let the species that built it catch up. That is progress of a sort. But a cost came with it. Legible imperfection yielded to opaque precision. The crooked specialist who sometimes abused power is gone. In place stands the perfect router whose parentage and preferences are hard to inspect. Society traded one kind of risk for another. What should be done now is less a list of predictions than a set of principles. Decide horizon. Machines dominate milliseconds. Humans dominate decades. A long horizon investor does not need to measure victory in the fourth decimal place, and a short horizon trader should understand that the sport's referees wear engineering badges. Use price as control. A limit restores dignity by forcing the machine to meet terms. Respect volatility. In stress, assume liquidity can evaporate and reappear at worse levels. Scale entries and exits. Diversify across venues if given the choice. Demand clarity about routing. Choose providers who can explain in straight language what they do with orders and why. And remember that free is a redistribution, not a miracle. For rule makers and architects, aim not for a market with no speed, but a market with many logics. Diversity reduces synchronized hazard. Experiment with intentional speed bumps where appropriate to blunt races that create no social benefit. Incentivize displayed liquidity that persists. Penalize pinging that amounts to industrialized eavesdropping. Require plain English disclosures about routing and data sales. Audit the objectives, not just the outputs. Algorithms should be judged by how they behave in tail events as much as how they enrich ordinary days. Beneath the debate sits an uneasy truth. The line between trader and market has blurred beyond recognition. Once, algorithms assisted humans. Today, humans assist algorithms. Speed itself has turned into money and proximity into privilege. There is a strange justice here because the same behaviors that can exploit the inattentive can also protect the patient. A router that conceals size until the last moment can prevent front running as effectively as it enables a different kind of race. The knife cuts both ways. The question is for whom and under what rules. Politicians talk about protecting investors. Exchanges talk about democratizing finance. Brokers talk about free trades. Open any of these boxes and find the same mechanic at work. A race against time, designed by those who sell the shoes and rent the track. The sensible goal isn't to eliminate black box trading. It's to keep it sustainable, auditable, and diverse enough that no single logic can topple the system when stress arrives. Markets have always been technology wrapped in rules, wrapped in stories. The technology has been updated. The rules have been muddied. The story remains familiar. This is fair enough, efficient enough, safe enough, as long as belief holds. Confidence is a shy creature. It evaporates faster than it forms. If it breaks, code will not blush. It will do exactly what it was told, and the illusion of effortless depth will drain in seconds. Then the memory returns of what a market truly is. A fragile agreement to meet in the middle, renewed every day by participants who accept the price, the rules, and the other side's right to exist. Knowledge does not guarantee immunity, but awareness reduces surprise. Learn the architecture, understand the incentives, and act with eyes open. History has the answers, know where to look.